all of this points to a much less inflationary environment. But the problem is that what equities have taken from that message is, oh, the Fed isn't so hawkish, we have nothing to worry about, without considering the economic weakness which leads to that situation. So the biggest risk really here is markets. I also agree on the China point, that is a risk, but again, mostly that's a market risk. That's market participants taking an old China buying commodity prices on the basis that China growth equals commodities. I suspect that this is a China recovery, more consumer driven, less investment infrastructure and debt driven, and therefore not as big a driver of higher commodity prices.
Okay, so China is different this time. And looking at the economic data, James, to your point, labor costs we saw yesterday trailed estimates. Energy costs have retreated. The price of core goods has declined, and the housing market is cooling. This is data that is showing that the Fed can stop. It can pause. Does it really need to push back against markets again if the economic data has begun to be loud and clear?
So again, with their actions, they're telling you exactly that they agree, because they are fully expected to and have been communicating that they will hike by 25, not 50, not 75. So there's been a relatively rapid slowing of the pace of hikes, because the Fed recognizes there's a lot of tightening already in the system yet to fully act. And indeed, there is now some encouraging data. The base effects for energy for these next few months are pretty powerful. Even if we get an oil rally, unless it's a huge one, it will slow the pace of disinflation. It's not at this stage going to lead to a re-inflation. But again, the problem is that the Fed tells us consistently and constantly that they see their policy as acting through financial conditions. Financial conditions are a sort of agglomeration of market variables. Therefore, they're mandated to attempt to control the market, which they obviously cannot do. And that paradox leads to these kind of communication challenges, where we expect a central bank to be more dovish because they're hiking rates by less, but also be more hawkish by telling us things about a distant future, which really they don't have much authority over, if you like. Remember, go back 12, 15 months, say, and the Fed was telling us that rates would be around 1% at this point.
Well, the swaps market, James, we've got it in the GTV library. This is 1 year and 2 year swaps. They are presuming that inflation is back, as you said, back at 2.23% in 9 months. And this goes to the point, it was a piece that was sent to me yesterday from Macro Compass. The bond market is in la-la land. Inflation at 2.5%, the Fed cutting to 2.75%, and real yields at zero. Is the bond market in la-la land if the Norges Bank, and your view is that maybe we get a second wind of inflation and these swaps are just far too aggressive?
First and foremost, we don't have a great understanding of inflation. Quite clearly, forecast error on inflation has been huge, but just in general, going back multiple years, previous cycles, economists' ability to forecast inflation has been very poor. The bond market has been slightly better, but still not great at all. So I will fully admit that ultimately I don't know. But again, there are some powerful forces acting in the coming months, not least base effects, but also the economic headwinds, the decline in real wages, the impact that we can see on consumers, particularly in the lower half of the income spectrum. All of these things are highly disinflationary at a time where economic data is deteriorating. Obviously, the fly in that ointment is the labour market. I will not claim to fully understand labour market dynamics because I think they have been affected by the pandemic. I do expect labour market weakness, and if I'm correct in that regard, I don't think the bond market is in la-la land at all. I think having some downside skew to what will be a very tight policy rate relative to anything close to neutral. The Fed still says 2.5, even if we call that 3.5, likely 150 basis points above that. is it unreasonable for the bond market to suspect easing will be necessary? Looking at M2
Perhaps
growth
not
year
in
on year.
that scenario.
Sorry,
So
Danny.
if the bond, well, I was just saying, perhaps not in that scenario. Perhaps the bond market isn't in la la land. Let me try equities on you, James, because we've seen profitless tech, meme stocks, ARK stocks, they're all up some 20% year to date. Even Bitcoin, Manis was mentioning this, is up 40%. We don't have much time here, James, so quickly. What about this equity market? What does this tell you?
La La Land. Equities have been in La La Land for many years, and this is the problem. This is just a Pavlovian response. We lived through this period of there's nothing really to say or do, but the Fed is the ultimate driver. Profitability of companies doesn't matter as much as the discount rate or abundant liquidity. There isn't abundant liquidity, negative M2 growth year on year. We didn't even get near that in the crisis. So the fact that the equity market is seeing easier but still tight policy as a reason to revalue these unprofitable companies, these speculative business models, is just a very concerning Pavlovian response, probably also a short squeeze because it was such an under-owned equity market.
Okay, so probably fair to assume you will not be chasing that rally. James, really fantastic to have you on the program this morning. Thank you for waking up early for us. James Athey, Investment Director at Aberdeen. Coming up on the show,